Hello all. Welcome to this first Energy Scan webinar session of the year. I'm Julien Waro. I'm in charge of the economic research team here at the ENGIE Global Business Unit Supply and Energy Management. It's not too late to wish you the best for this new year. So today we will explore together the energy market outlook for 2026, a year which started with a busy geopolitical news flow and strong volatility in energy prices, especially in Europe and in the US. We'll cover today the main trends we foresee for the coming months, notably regarding the upcoming LNG glut and the expected drop in CO2 emission allowances supply in Europe. In this session, I will be joined by the economic research team, namely Olivier Gasnier for macroeconomy and crude oil, Évariste Nuki for natural gas, Paul Chavy for CO2 emissions, and Luc Ruffier for power. So, as usual, check out the buttons on the bottom right corner of your screen to ask questions to our speakers or chat with participants and leave some suggestions to the team. We will do a Q&A session at the end of each presentation. So I remind you that the session will last 90 minutes and not 1 hour, a bit more than that. So finally, you will also be asked to fill one question satisfaction survey at the end of the session. Regarding the slides and the replay of the session, they will be available by tomorrow at the latest on our EnergyScan platform. But you can already download them by following the instructions displayed here. So just click on apps, then handouts, and you should be able to download the slide pack in PDF version directly. Before we start, I would like to take 30 seconds for a very important topic to invite you to vote for ENGIE and EnergyScan at the 26 energy risk commodity rankings. So these rankings are a large survey conducted every year by risk.net, which is a market reference risk management and trading review to rank the energy companies that have best performed throughout the year. So you can either scan the QR code displayed on the slide or click on the link that should appear on your screen. And if it's not the case, I will share the link directly in the chat. So answering the survey should not take more than a few minutes, and every vote counts to keep EnergyScan at the top of energy market research. So thanks a lot to take some time to voice your opinion on this. So it's time to move on to the first part of this session with Olivier. Hello, Olivier. The floor is yours.
Hello, Julien. Hello, everyone. So thank you, everyone, for joining us this morning, and Happy New Year to everybody. I think with a bit of experience, you know that you have to be humble with economic forecasts, but it's probably really truer than ever since the election of Mr. Trump. The multiplications of tensions and geopolitical events for the last 12 months is really impressive. It has led to total destabilization, I would say, of the international context, and that was probably far beyond what was expected or what was feared at the start of his second mandate. So it's not a surprise to start with some words about the geopolitical context we have put on this chart, on this map. Some examples of the recent events that have occurred. And I think so of course you've got on this map, of course, still the war between Russia Ukraine, for example, or you have also tensions between China and Japan notably since the election of the new Japanese prime minister about Taiwan. But probably the most surprising thing when you look at this map is the key importance of the US and involved in many events, many interventions abroad which was a bit at odds with what Mr. Trump promised, and to focus on America first. But America first now means a new strategy for the international policy of the US, what we call the Monroe Doctrine, by reference to the Monroe Doctrine of the 19th century. And that means that the US considers that the Western Hemisphere, so all America, is concerned is own the own security of the US. So we have seen, of course, the intervention in Venezuela. We have seen threats against Cuba, against Colombia, Nicaragua. We have, of course, all those this discussion about Greenland that was really the center of the Mr. Trump speech at Davos yesterday. But there have been also interventions in Nigeria, Somalia, for example, and we were very close to intervention in the recent event in Iran, for example. So multiplication of events in the world, and all this contributes to a geopolitical context that is really deeply unstable. And so it's a bit strange. I mean, that was also probably really unexpected. The fact that when you look at this context that is very unstable, you have had almost no consequence on economic performances in 2025. And for 26, of course, this is about the same. If you look at the forecast, I mean, you have on this chart just the evolution of the consensus forecast for GDP growth for both years, 25 and 26. And you have also the graph at the bottoms, the bottom, they describe the evolution of forecast compared to the starting point, which corresponds to the election of Mr. Trump. And you can see very easily, of course, the plunge in forecast, especially for the US economy after the Liberation Day, the famous Liberation Day when Trump announced all the tariffs applied to trade partners. And you can see after that there has been a slow but gradual recovery. And at the end of the day, both for 25 and 26, and except for maybe for Europe for 26 so far, there has been this recovery, and the performance of in terms of GDP growth has been higher than even before the announcement of those tariffs in April 25. So this is of course clearly a surprise, because of course we could expect a very damaging effect of this policy on the economy. As you can see on this graph, that concern mostly the US economy first, and that corresponds to the economic theory that shows, contrary to what Mr. Trump says, that the country that applies tariffs will suffer first of the consequence of this policy. So what did happen for the US economy first? The first response can be what we have seen yesterday. That is to say, the acronym TACO, Trump always chickens out. The idea that Mr. Trump speaks loudly, but after that he always make compromises, and have deals. This is not entirely true. I mean, when you look at the evolution, for example, of the average effective tariff rate in the US, they have increased notably for every country, and the average is now around 17.5%. Compared to something around 2% before Mr. Trump second mandate. So this represents an increase of 15%. And if you compare to the historical level of tariffs in the US, this is the highest level since the years before the World War II. So this is clearly significant. And you cannot consider that finally the announcement on tariffs was not followed by acts. Second possible explanation that is very true in my opinion, is the sharp rise in artificial intelligence. And when you look at the expenditure and private investment in IT equipment or software, you can see that all this represented almost 40% of US GDP growth in 2025, which is more actually than during the dot-com bubble at the end of the 90s. So this is very, very significant, and that had been clearly underestimated at the start of last year. The last possible explanation is what we call the K-shaped recovery in the US. What does it mean? It means that actually there is, when you look at the evolution of consumer spending in particular, or the situation of households, when you look at their level of revenues or the level of their wealth, there has been a widening spread between the wealthy people with higher revenue and the situation of people with low revenue. And that can explain, for example, that consumer spending has remained strong despite an extremely low level of consumer confidence, or the fact that we have seen a kind of freezing of the job market with no job creation anymore, with no consequence at this stage on the consumer spending, because consumer spending has been precisely supported by people with higher revenues. And we have seen something that has been strange actually, with the highest revenue increasing more than the lowest revenue on a year-on-year basis, for example. And of course, the wealthy people have benefited from the surge in the stock market, etc., and the sharp increase in the value of their savings. So this is something also that can explain that finally the US economy has been extremely resilient. As far as the other countries are concerned, also we have to look at the consequences of the trade war. So first, if you look at the US trade balance, I heard Mr. Trump saying yesterday that the trade deficit had been reduced by 77% since the start of his mandate. That was factually true, actually, but it's completely wrong. I mean, if you look at the evolution of the figures month by month, because what we have seen at the start of 25, when it became obvious that Mr. Trump would apply tariffs to other countries and would launch really a big trade war against the US trade partners, has been a kind of front loading of imports. I mean, everybody rushed on the imports to have goods before their price increase due to tariffs, and so that has completely changed the shape of the external trade in the US during the year 25. So even if you have a reduction of deficit at the end of 25 for the US, it is because you had an enormous trade deficit starting in at the start of the year. If you look at the sum over 12 months, which I have done on the graph on the left, you can see that finally, at the end of the day, the level of deficits in 25 will be not really different from the level of, it will be even a bit larger than the deficit at the end of 24. In terms of evolution for the other countries, it's interesting to see that, for example, for China, there has been a really a reorientation of trade with a sharp decline in exports towards the US and a push towards the other Asian country with probably the intent to re-export then towards the US, but coming from other countries with lower tariffs, and also a push towards Europe. And you have exactly the same behavior for Japanese exports. We had the Japanese external trade data this morning, so the graph has been updated this morning. You can see that while there was an increase in total exports of Japan by 10%, exports towards the US were flat actually, and exports towards Europe were up by around 18%. So it's interesting because you have no big change for Europe when you look at figures for Germany. There is a decline, nevertheless, on export. But the consequence is that you have a greater competition coming from, especially from Asian countries, due to the implementation of this trade war by the US. So the consequences are finally, nevertheless, negative for Europe. When we look at 26 prospects, it's important to have in mind all of this. And I think it's fair to start with politics on what will happen for the US. So you have two factors actually. I mean, the foreign policy and the domestic policy. By foreign policy, of course, what will happen with Ukraine, with Greenland? Apparently, there could be a deal, which is not very surprising. What will happen with this famous downward doctrine? There are rumors that the US will seek a change of regime in Cuba, but that will have little consequences at the global level. After that, you have a possible US intervention or even indirect intervention in Iran, Colombia, for example, etc. So, I mean, we don't know. It's extremely difficult to anticipate what will happen because we have those kind of surprises coming every week. Since the start of 26, for example, we had first Maduro, then Powell, and then Greenland for the first week of the year. So that brings lots of instability and with potential economic consequences. So I talk about. I just mentioned Powell because this is one of I think the two main points of the domestic US policy that will be important for economic forecast that concerns the Fed's independence. And that maybe is a source of a bit of optimism in this context. The fact that, so you know that Trump has done everything to replace Mrs. Cook, apparently inside the Fed board, the Supreme Court has rejected or will probably reject his calls, his requests, because they judge that these are completely unfounded. And you have also the replacement of Mr. Powell, because the mandate of Jerome Powell will end in May 25 as a president of the Fed. We have seen that there is a kind of rebellion inside the Republican Party in front of the possible possibility that the US administration would take control of the Fed, actually. And this has led Mr. Trump to abandon the idea to put his main economic advisor, Mr. Asset, in place of Mr. Powell. So this is important because it shows that things can move if there is some reaction inside the Republican Party, but that would be important. Second element, extremely important in my view, the midterms elections at the end of the year. Because yes, the polls and the low popularity of Mr. Trump, they all point, anyway, for each presidency, the midterm elections are generally a defeat for the president that has been elected 2 years before. So this is the first point. But in that case, we can really anticipate a big defeat of the Republican Party. The question after that is, given what we have seen so far, will the midterm elections take place normally? Will Mr. Trump accept his defeat, etc.? These are big questions. I think this is very, very important. If that's not the case, I think in terms of economic impact on markets, we have seen that with Greenland taking shape in the last few days. You could have the resumption of the sell the US trade. That means that traditionally the dollar, the treasuries, they play the role of a safe haven on markets. And this has not been the case because you have this opposite movement, or the market, the investors on market sell actually the US assets. And this is very important, and that could, of course, worsen if we have such developments. A second point that will be important, but I will just come back on the next slide. This is the fact that we will have early elections in Japan. The goal for the new prime minister is to have a majority to impose a massive recovery plan, while the indebtedness of Japan is already very high. You have also a normalization of the BOJ policy, with rates going higher and higher at odds with the move we have seen in other countries. So the consequence of that, you have higher bond yields in Japan with potential consequences for all markets. For Europe, one of the questions I think that is really important is, will the German recovery materialize? Because the other countries have no room for maneuver, no fiscal room for maneuver. Germany has. They have announced a massive recovery plan. We haven't seen the consequences of that so far. There have been an acceleration of the rebound in industrial activity at the end of the year, but actually this rebound just erased the plunge we have seen the months before. So far, it's very difficult to see convincing signs of recovery in Germany. And for China, well, I think, in economic terms, this is more or less the same. China achieved a 5% GDP growth in 25, but at the end of the year, on a year-on-year basis, growth was only 4.5%, and the structure of growth just confirmed that you have still this housing market crisis. You have still very weak domestic demand, and the growth model of China depends more and more on exports. And so there is probably more general questions about China, which role for China in the face of US activism. Will they decide to open a bit more their economy, to have negotiations with Europe about the trade, etc. These are interesting questions about the role in China and the center of the global economy. But anyway, I think that the goal to have 5% GDP growth for China can be abandoned in 25. So just to illustrate what I said about Japan, you have on the graph on this slide the evolution of the 10-year bond yields for the main countries in the world, and also the evolution of the trade-weighted indices, for the main currencies. So currencies against other currencies. And you can see very clearly the sharp rise in Japanese bond yields, now much higher than the Chinese bond yields, and now not very far now from the level of German bond 10-year bond yields, for example. That can have consequences in terms of the famous yen carry trade, which was the alpha and omega, if I can say that, of the investors for many years. I mean, you borrow money in Japan at 0 rate, and you put your money in countries where with higher yields. That can change if you have such a rise in Japanese bond yields. So far, it has no consequence because the yen is extremely weak and has weakened precisely due to anticipations of a massive recovery plan for an economy that is highly indebted. But this is a threat. I think you have to keep that in mind. The rise in Japanese bond yields at some point can have very destabilizing consequences for the rest of financial markets if you have a massive repatriation of funds from the US or Europe towards Japan. I will accelerate a bit because I'm late, I know. Just show some forecast, but you have understood that we have to remain extremely humble with those forecasts. I mean, I have essentially prolonged trends. I mean, I think for 26 you can expect, for example, that the US economy will remain strong, etc. But that can change. I mean, due to, for example, really a political mess at the end of the year, or this kind of things for 27, and that could have big consequences. For Europe, I have remained cautious so far, but maybe you can expect some positive impact of the recovery plan in Germany if that really materializes. And I think the incentive for that, especially to increase the defense expenditure, is strong in Europe. So maybe we can have some positive surprise there. And as I told you, I don't think that China can be able now to keep a 5% GDP growth goal, and probably GDP growth should slow down. But all in all, growth should be still really acceptable, I would say, at more than 3% at the global level this year. I will just say 2 words about oil, because it's really more or less the same for months. I mean, you have a downward trend that is explained by expectations, and even that has started in the second part of 25. You have an imbalance between supply and demand of oil. Supply, of course, you have oversupply. For example, the International Economic Agency, they repeated their forecast of a massive oversupply for this year at 3.7 million barrels per day. Okay, so this explains this downward trend, and also you can expect from Trump to try to act to pull oil prices lower, as he did in Venezuela, for example, before the midterms, to lower the price of gasoline in the US. But you have seen peaks explained by geopolitical tensions, as it had been the case recently, especially with the situation in Iran. So this is really this global picture. On last slide, just to illustrate what I said about this oversupply. I tend to think that probably oversupply will not be as high as the IEA expect for 26, but it should be at least very big, as in 25. I mean, probably more than 2 million barrels per day. So that will continue to exert a downward pressure on prices. And so this is why, I mean, if things calm down in Iran, etc., we should see probably prices, Brent prices coming down to 60 or even a bit below 60 in the coming months. The situation, the fundamental situation, really point to lower prices. I'm done, Julien. I don't know if we have some questions about all this.
Thank you, Olivier, for this introduction. So, yeah, we have a question, but I think you already answered it regarding the midterm elections and the link with the current geopolitical situation. So as we are already a bit late on schedule, so I just have one question, Olivier, regarding the Euro USD rate outlook. What is your view on that regarding all those elements?
Well, what we have seen is a massive, as I said, massive weakening of the US dollar after the Liberation Day. Or more or less, the euro dollar was close to the parity at the start of last year, around 103, 104. And now the euro dollar has stabilized around between 116, 118 since the middle of last year. There is no convincing signs of recovery. You have expectations of lower Fed rates, even if there is not a clear loss of independency of the Fed. The market expects 2 more rate cuts coming from the Fed with stable rates for the ECB. You have all those potential political events that could come from the US. I'm pretty convinced that midterm elections won't happen normally at the end of the year. So I would be really tempting to say that despite the sharp decline in the euro, in the dollar against the euro or other currency last year, risks could be still on the downside. So that means a higher euro dollar for the probably for the second part of this year.
Okay, thank you, Olivier, for your answer. So let's move on to the second part of this presentation with Évariste on the natural gas market outlook.
Thank you, Julien. Hello, everybody, and Happy New Year. So let's start this review with a view on the European gas balance. So last year, demand was slightly up, mainly supported by higher demand in the power generation sector, amid lower wind generation and also some cold spells. But strong LNG supply helped to offset this increase in demand, in addition to offsetting the loss in Russian supply. But overall, this was not enough to help European gas stocks to be comfortable. As you can see it on the last row of the table, we still have a strong storage deficit. The question we could ask now is that storage deficit a problem? Is it still relevant to compare these stock levels to the historical average? Of course, we are well below the historical average, but at some point we could consider that LNG is a kind of floating storage. Yes, but the big but is that this storage is price sensitive as far Europe is concerned. It's not the case in Asia, because in Asia they tend to buy their LNG via long-term contracts, meaning that this LNG supply is secure. Whatever the spot price, they still receive their LNG. But for Europe, it's not the case. We still buy in Europe a lot of LNG volumes via spot prices. These are flexible LNG supply. Those supplies, of course, are at risk. So to continue to see those spot volumes entering Europe, we need to continue to see a strong increase in US LNG supply. It is the case. So last year, US consolidated its position as the number one LNG exporter ahead of Qatar and Australia, increasing supply by almost 30 BCM. And we expect this supply to continue to increase this year, thanks to the ramp up of some LNG plants like Plaquemine or Corpus Christi Stage 3, and also the expected startup of Golden Pass. So US should continue to support global LNG supply for this year and for the years to come, because we expect LNG supply to continue to increase through 2030, mainly from the US, of course, but also from Qatar or Canada. But be careful. These are installed capacities. What does it mean? It means first that you can still have some delays. And second, and more important, we are talking about capacity. We are not talking yet about actual supply. Actual supply means that those liquefaction plants are running at high utilization rates. But for that to happen, you should have an incentive. The netbacks, the margin should be attractive for LNG producers to continue to export LNG. For now, this is not really an issue for Europe. Europe continues to receive massive LNG flows, particularly from the US, thanks in particular to the fact that Asia is taking less. On the graph on the left, you see Asian LNG imports. They were down by around 5% year on year last year, mainly because of China, almost 16% down. As you know, China is also a gas producer, so they continue to increase their domestic gas production. China is also importing pipeline gas from Russia via the Power of Siberia pipeline. So all those elements make China less dependent on the LNG market, because they can reduce their demand when they believe that prices are too high. Don't forget the coal market as well. They can also use more coal if the gas market is tight. So strong drop in China, strong drop in Asia. Europe continues to increase its LNG imports, and you see on the graph on the right that this year we continue at roughly at the same levels. The market consensus is that this will continue. Yes, of course, because when you look at what is happening in terms of liquefaction capacity, of course, we believe that these flows should continue. But we'll see in the next slide that there are some risk factors. And the main risk factor for us is coming from the US, of course. Here you have some comments about the US flows in last December, with Europe consolidating its number one destination zone for US LNG, with around 78% of flows, up from the value in November, while you see, by contrast, the drop on the Asian share, because Asia, as you just mentioned for China, for instance, they can say, no, prices are too high, so we reduce our LNG imports. Note that there are also some small buyers of US LNG. You can talk about Turkey, Egypt, or Latin American countries, but those are taking rather weak flows. And clearly, for the US market, the main destination continues to be Europe, provided that there is an incentive to export to Europe. And for that, we could move now to the graph on the left, split in two. The first is the netback. The netback here is the one computed by Refinitiv Econ. What they just do is to take the landing price in Europe, in Asia, in Latin America, in Egypt, minus the shipping cost. So you see clearly that the trend, let us to make it simple, it's like if you take the TTF minus the shipping cost. And the second important element in this chart is the feed gas cost. The feed gas cost, we assume it as being the Henry Hub price multiplied by 115 and 15%. So this is the feed gas cost. The difference between the two graphs, you can consider it as the gross margin of LNG producers. Why is it the gross margin? Because by just doing that, you are not factoring yet the liquefaction cost. And you see clearly that while TTF prices were falling out, don't forget that for a while they were falling out since, let us say, the end of last winter, they were falling. But at the opposite, you see the rebound in Henry Hub prices, which reduce the spread, reduce the margin. In a competitive market where you can say, yes, okay, liquefaction is a sunk cost, probably you would have reached a closing of the spread. But what the graph is telling us is that no, some players still want to receive a price for the liquefaction activity, which means that we are not closing totally the spread. Now, the risk for Europe is that the Henry price is bullish. Just look at the end of the graph and come back to it with more details later on. If the feed gas cost is increasing, if you maintain TTF prices at stable levels, you are reducing again the incentive to export LNG, and probably you will have a drop in LNG export to Europe. So the only way to maintain the incentive for LNG producers to continue to produce is to increase the TTF price. So clearly what is currently happening, I believe, is a bidding war between the TTF and the Henry Hub, because to simplify things, you can just consider that this graph, you can simplify it by the spread between TTF and Henry Hub. So bidding war between the two, just to say that for Europe, competition right now is not coming from Asian buyers, but it is competition between European buyers and US buyers. Because US is not only a major gas producer and LNG exporter, but US is also a major gas consumer. When we start, I talk about LNG that can be considered as a floating storage. This is even more true when you take the US gas balance. When you look at the last part of this table, talking about supply, you see that when the US withdraw gas during the winter, take Q1 of this year, for instance, this gas is also what is used to export LNG. Of course, it's not exactly like that. They will use production plus gas from storages to export LNG. But when you look at the numbers, they are very close. What does it mean? It means that if it is very cold in the US and they don't have enough stocks because they need to supply their domestic consumption, the ability to export LNG will be in danger. This is true for the winter when you need to withdraw gas to export. This is true as well for the summer. During the summer, just look at the table, they need to inject a lot so as to be able to take that gas during the winter. So if for whatever reason during the summer, the ability to inject gas is not there, the problem will spread to the winter as well. Just to say that now that Europe is highly dependent on US LNG, European buyers will be more and more affected by changes in the US gas balance. And look at now the trend on entry prices on the right. They were down until recently, falling below the 1-year average and even below the production cost of some dry gas fields. And at that point, we start to hear some saying, okay, production will weaken. And again, if you look at the table, you see that for this quarter and next quarter, we expect low supply. Of course, these are forecasts. These are not our own forecasts. They are coming from the Energy Information Agency. The last report was, let us say, early Jan. At the time, prices were falling. I believe that what the agency factored here was just the fact that with falling prices, you could not expect US gas production to continue to increase. This show you the sensitivity of US LNG, US gas production to prices. So bullish Henry prices since this week. Why? Because we are expecting freezing temperature in the US with two effects. First, higher heating demand, bullish Henry prices, and second, even a freezing of some oil and gas fields. If you have this freezing, this also means that supply will be constrained. And why not also a disruption of LNG export? This is also why the TTF is reacting so far and so strongly to the bullish fundamental we are having in the US. So this reaction, you can see it here. You just start with the graph on the right. First, to see that Asian buyers are not ready to overbid. You see clearly that despite the rally in TTF or PEG prices, the GKM is much more moderate, sticking to Brent prices. Yes, because as you know, they still have a lot of gas contracts indexed on oil, so they can rely on those contracts, and they are not going on the spot market to pay a high price, which is not the case for Europe. To be honest, at some point we were surprised by the rise in prices above the Brent, because we believe, as some market participants, that the fact that Asian buyers will reduce their imports will help the TTF to be capped by the Brent, but this did not happen. And then look at the graph, the two graph on the left. It did not happen because in this market, as you know, you don't only have physical players, you have as well some financial players, investment funds, and they were at that point they were short. They were they had some selling positions, and when prices started to increase, of course, some of them were obliged to stop loss. So to me, and when you look at the TTF month side graph, clearly what happened was that prices crossed a technical level, because at some point you should have expect the technical resistance to stop the rise. It didn't happen. So stop loss, and the stop loss pulled the price above the 1 year average. And again, at that 1 year average, I was among those expecting this 1 year average to cap the rise. But now the risk clearly for buyers is to see the bullish momentum remaining for a while. And for that, just look at the graph on the left on TTF, on the left, on the bottom left, on the TTF calendar contract. You see that for a while, the calendar 27 did not react a lot to the bullish momentum, but now it's not the case. And the graph is not updated with the data from yesterday. They are trading now above their 20-day high. Normally, they should not go much higher, let us say up to their 1 year high, but you never know. And to me, this will highly depend on what investment funds will do. Here we show the TTF quarter contracts versus the investment fund position. Investment fund, they were strongly net long, let us say early Feb. And from that period, they start to cut this position. They are like the physical players, they also look at the fundamentals, and the fundamentals appear to be bearish. So you can understand why most of them start to cut their net long position, and the position turn net short from mid-November. But recently, with the surge in prices, as I say, some of them were obliged to stop loss. So first you close the position, you can move to a net position at zero. But some of them even start to take some long position. You see that the position is now switching to net long. Now they are facing a difficult choice. In the very short term, the fundamentals are bearish. Stocks are weak. In the US, there are some risk factors. Of course, in the near curve, you can be bullish. But in the far curve, We expect more LNG to come, meaning probably no need to pull prices toward oil prices. And you can see clearly that the quarter two 2027 is weaker. But the risk now is to know how the spot tightness will spread to the far curve. And this will impact heavily the calendar 27. If for whatever reason some players believe that the tightness could extend because you are not filling the stock proper, you are withdrawing too much from the storage, you have some concern about how to fill the stocks next summer, and again spreading the tightness to the next winter. Why not seeing some of them starting to take some long positions on the far curve? This is a risky position, but you cannot totally rule it out. And what could help some to take some long positions clearly is the balance. What do you expect in terms of balance? And you have to admit that compared to a month ago, where we were rather comfortable about the European gas balance, we are a little tighter. Yes, we still believe that. And just look at the table. This is a slide we show on the monthly. I guess you know this one. So central scenario is scenario 2. We believe that yes, stocks should remain comfortable, but you cannot totally exclude a scenario where because of some tightness in the US, so the US being unable to deliver the LNG Europe is asking for, because of this risk, you cannot exclude a scenario where you will end with stock levels between scenario 2 and scenario 1. Probably, if we continue to see the spot tightness, some players will start to assume that this scenario is not totally to be excluded. Then to finish, let's come back to the global view. Again, a month ago, you were just saying that the decoupling between gas and prices was done, total. Now we have to admit that this decoupling is not total yet. By total, we mean for the whole year. Of course, decoupling during the summer is rather normal. We were expecting the decoupling to happen even during the winter. But what we are seeing right now is that no, during the winter, we still have some tightness. Probably we'll have to wait until next year to see the decoupling. And even this view now is not so clear. If you remember well, the graph with the quarter one on the TTF, you see that quarter one is expensive as well, quarter one 2027. Meaning that, yes, you could expect some tightness even early 2027. And if you continue to see the spot fundamentals tightening in Europe, in the US, probably you could as well say that, yes, we could extend the tightness until summer 2027. Just to say that the market will continuously adapt to what it is seeing on the spot. The decoupling will happen, okay, but every day with tightness in the European, the US gas market will tend to push further ahead the decoupling. And don't forget as well that in their decline, prices should find support, of course, on the US short-run marginal cost. And don't forget that the real price is not in contango. The real price is not in the backwardation. The real price is in contango, which clearly show that people are not ready to sell their gas at whatever the price. So contango, so meaning that the support will tend to increase. The coal market is not in contango yet, but you can have a kind of stabilization, because don't forget that Chinese authorities goal is clearly to make coal prices stable. So the support will be stable too bullish, so risk factor as well for the TTF. That's all for me, Julien. I don't know if you have some questions for me.
Yeah, thank you, Evaris, for this presentation. Yeah, we have some questions for you, so I will try to summarize them to go as quickly as possible. So you showed the chart about the build-up of LNG export infrastructure in the coming years. So we have two questions. What about LNG shipping capacities in front of that supply build-up? And also, what about regasification capacities in Europe? Do we have enough to cope with this increase in LNG supply?
I will start with the simplest. For regasification, there is no issue. There is enough in Europe. So regasification capacity is far above the needs. So no issue on that. On shipping, it's a little bit more difficult. Let us say that for the new liquefaction capacity in general, when it is tied to long-term contracts, you have the shipping width. So no issue as well. But yes, from time to time, on a spot basis, when you need LNG in a hurry, it was the case until recently, with a strong competition between Asia and Europe to attract more LNG, yes, you can have some constraint on the shipping. But Asian buyers have showed that they are ready in those cases to reduce their import to recourse to pipeline gas in the case of China or coal. So yes, you can have some tightness on the shipping on a spot basis, but at the end, it's not really an issue. And I can add that this is a problem for Asia because we are closest to the US. So when there is a tightness on the shipping, it is Asian buyers that are suffering more.
Okay, thank you. We have also several questions regarding the US gas market and potential restrictions on US LNG exports to keep US gas prices at a relatively low level. So, is there a scenario, possibility that at some point we have some restrictions or export tariff potentially on US LNG?
First, you can say that this is a competitive market. When you talk about US, it's not China. The question was on China, yes, I would say okay, you can have a political decision to restrict flows and so on. Not in the US. So it's the market that will decide. Yes, at some point you could say that, of course, the fact that LNG exports are increasing, this is increasing the price for US buyers. And some of them are complaining, industrials, households in the US, they are already complaining about that. But the answer the industry can give them, and the answer, let us say, Donald Trump can give them, which is a strong support for LNG exports, is that they are earning a lot of money from those exports. So on one side, okay, this is a pain for US consumers, but on the other side, they are earning a lot of money from LNG exports. So at some point, they will have to decide where they want to put the focus.
Okay, thank you, Evariste. I will stop there for the gas Q&A, but we'll take some time to answer to the other questions right after this presentation. So don't worry about that. So hello, Paul. It's time to move on to the carbon part of this presentation. So floor is yours.
Hello, Julien. Thank you, and happy New Year to everyone. And yes, let's deep dive onto the carbon market, which 2026 will be, of course, a very interesting year, and we'll just see why right now. So first of all, on the recent price evolution, so the recent months for US can be only described as a perfect bullish setup. So as we look at the recent price evolution, the graph on the left, you'll see that you guys have maintained a strong upward trajectory since September. And this rally is being driven by three converging factors. And first, the most important one is that the market is aggressively pricing the 2026 supply-demand balance that you can see on the graph on the right, which is expected to be exceptionally short, mainly on auction reduction, but we'll come to that just later. And second, we just moved through the free auction period between December 15th and January 7th, where the lack of supply provided a significant tailwind for prices. And third, we faced quite cold conditions recently with moderate renewable output during that period, which is driving up fossil fuel generation and demand for e-waste. But however, so as in last April, on what was already mentioned by Olivier, with rising geopolitical tensions and the tariff, and as US trade as risky asset, market participants quickly reduced their exposure, resulting in a short flash crash, as we can say that, at this very beginning of the week. And even though this is already finished, events that like that cannot be ignored and could happen again this year. And what has also been quite impressive this year is a widening spread between gas and carbon. So we are seeing a structural decoupling. So while gas market is looking at a potential surplus, the EU ETS here is entering its most aggressive tightening phase yet. So last year we saw US moving in tandem with gas prices, but today the correlation has dropped to near record lows. And even when clean gas costs fell recently, US held their ground, and we are moving away from the old fuel switching logic onto more of a market driven by absolute scarcity, but also driven by the fact that the power sector will represent a smaller and smaller proportion of the ETS in the future. We'll talk about that just later. And to understand more this decoupling, we have to look at the power sector. So here on the left is a chart of the reserve load in Europe, and on the right on the coal and lignite power generation in Europe, which is by far the most emitting. And what can be seen is that despite the recent very cold conditions, coal and lignite power generation remain subdued, which clearly shows that the coal phase out is a current reality. And as you can see, most of the incremental demand, if I come back here, was met by gas-fired power generation. So for carbon, this means that the switching arbitrage is quite losing its status, and the carbon market is less sensitive to gas price volatility as clean gas costs dropped. If we now look at the total emission for 2025, so for the first time since 2018, we have the total emissions under the EU ETS that actually grew year on year, rising about 11.3 million tons on our first estimates. But the headline is a little bit more deceptive because if you look at the breakdown, industrial emissions were actually down based on industrial production data, and particularly in the cement and chemical sectors in the others category. While power emissions grew by about 5 million tons due to the cold beginning of the year mainly. But the real cause of the growth here is the maritime sector, which added nearly 24 million tons as it continued its phasing into the ETS. So it was 40% last year, 70% in 2025, and now 100%. And without maritime, the ETS would have shown a net decrease in emissions. But as we move into 2026, the maritime sector will now be fully integrated, meaning this upward pressure is now a permanent fixture of the annual balance. And now let's move on to what market participants are anticipating on why the price action has been so aggressive recently. So basically, speculative activity has hit an all-time high. Investment funds are currently holding a record net position of 125 million tons, which is very impressive. But the most important metric isn't just the volume, but is also the number of participants, which is increasing, and it is at its highest level ever recorded. And this expansion is a critical signal because historically, when we see this many players entering the market simultaneously, it provides the liquidity and momentum for sustained and multi-month rallies. Just when we saw this in 2021, when the supply-demand balance evolved from equilibrium to short. And if we look at the option markets, so the graph on the right, so this is the average open interest strike price per maturity. So what you can see here is that there is still upside potential as early as March, where some market participants already have an important open interest for 100 euros per ton. And with the interest for December, which is quite the same as March, but which clearly shows the high expectation for this year for market participants. And now let's deep dive into the most significant policy change, which is the CBAM. So as of this month, the CBAM is officially live for all imports in the EU ETS scope. And so the goal here is simple, is to avoid carbon leakage. And starting from now, importers must account to the embedded emissions of their goods. And so the most important sector in terms of imported emissions are steel, cement, and chemicals, with, as you can see, the steel sector being by far the biggest player here. So if we look at the data, so on the bottom right here, Turkey is the top supplier of steel to the EU, followed by South Korea. And these exporters now face a carbon cost equivalent to what European countries would pay. But this also means that it could reshape the suppliers of the EU, where importers want to find not only cheap, but also low carbon steel products. However, it does not mean that the EU ETS balance will increase by 150 million ton next year, which here on this graph and on the donut graph is the imported emissions in 2025, because CBAM imports will be linked to free allocations. And indeed, to remain compliant with the World Trade Organization rules, the EU is phasing out free allowances for domestic industry at the same rate it phases in CBAM for importers. So importers must pay for the emissions of the product, but receives a discount equal to the free allocations a European producer would still get. So as the balance is quite even between a free allocation and demand for these sectors, it would only add very few emissions for now. However, the discount is shrinking very fast, because if we now look at the free allocations balance for this sector, the goal is to be at zero free allocations from here to 2034, which will make the balance very short. So here on the graph are the balances of the average biggest steel and cement producer in Europe. So for the steel and cement sector, currently the biggest player in the sectors are still technically long, because they have spent years accumulating a surplus of free allowances that acts as a buffer. However, because free allocations are not decreasing so significantly, that surplus is expected to be depleted rapidly, and it already faces strong criticism from the industry side. But other sectors are also in a more difficult situation. Here, if you look at the average biggest chemical manufacturer or the biggest airlines company, indeed, chemicals and aviation are in a much tougher position. So the chemical sector is almost already short, and aviation is already very short. And it's, airlines in particular have seen their full allocations cut much faster than other sectors, while their activity levels have recovered. It's actually the only sectors where emissions are growing year on year. And it faces very strong criticism from top industrials, saying that the carbon market should be abolished and that it is pure madness for Europe. We also had the Ryanair CEO that even said that only Europeans would design a system as stupid as this. So to show you the level of my contentment. And for the industry as a whole, the safety net is being pulled away, and tension will grow for industries. Our free allocations are removed. And even the sectors that are currently long will find themselves entering the market much sooner than they anticipated. Because if we look at the balance to conclude for the next year, as you can see on the chart on the left, so this is the monthly supply and demand balance. We're entering a period of structural scarcity compared to the previous years, with the linear reduction factor that is cutting the cap, the social climate fund, and the Report EU front loading, which gave us extra supply in the last couple of years, are now coming to an end. And adding to that, the phase out of free allocation, the supply is going to decrease very sharply. And meanwhile, with a stable demand expected and with a record number of speculators holding the floor, the path for US prices is firmly upward. So ultimately, as we move into this era of record high prices and rapidly disappearing free allocations, European industry will have to adapt and accelerate its decarbonization efforts far more rapidly than what we've witnessed over the last decade. And that's it for me, Julien.
Thank you, Paul, for your presentation. One key question in the chat regarding the link between EUA prices and other commodities or assets. So the price of gas and EUAs had a high correlation for a long time.
Yes.
You showed it, but this is gone since the end of last summer. As speculative players went long on EUAs and short on gas. So question is, are EUAs and the stock market now correlating more?
Yes, that's quite a very good question, because yes, so gas and carbon were very much correlated in the last year, as power sector represented the largest part of the ETS. But now, as it's decreasing, and it will be more like 25-30% of the sector in the next year. I think that's a good way to look at correlation with other markets is the stock markets, and mainly the industrial stocks. I think carbon will be correlated with industrial stocks in the next years, because that will be the greatest part of the ETS. Yes.
All right. Thank you, Paul, for these
Thank you.
presentations. So it's now time to move on to the last part of this presentation on the electricity market with Luc. Hello, Luc.
Hello, Julien. Hello, everyone.
The floor is yours.
Thank you. Yeah, so hello, everyone. Happy to be here today. I'll try to complement everything that was already said on the gas and carbon part, with a view on the power market and its possible developments over the next few years. So first, let's start with an overview of demand, and to have an understanding of where we're coming from. You can see that in 2025, if you look at the 5 biggest markets, so Germany, France, Spain, Italy, and Great Britain, we only grew by 1.1%, which is quite moderate. But this growth is to be put into perspective with the previous demands, levels of demands. We are far below the pre-crisis era, still about -8%. So there's still a long way to recover this initial demand. The picture is a bit different from one country to another. There's pretty strong growth in Spain. It's also strong in France, but there are some weather effects that can explain this development. While, for instance, in Germany, it's pretty slow, only 0.65% between 24 and 25. And for the case of Germany, there is a structural decline of industrial activity that is explaining this evolution. So we can say that there is some growth for demand, but it's still a long way from recovering. If we dive into some sectors of the demand side of power, the first thing to look at is industry. It represents a huge part of the baseload demand, especially in Germany. And looking at two sectors, chemicals and metals. So here's the chart for metals on the left. You can see a gradual decline of activity of this sector, which represents about 5% of the whole demand in Germany, which is significant. So if this sector is impacted, then you could expect a lower power demand overall in the country, which offsets some gains in other parts of the demand, especially linked with the electrification. So that it's the two charts on the right. First, we can look at transport and electric mobility. In 2025, so based on the estimate that we have, we are seeing a growth in EV sales in Europe as a whole. We've actually a pretty strong rebound in Germany for EV sales, while the overall car market is pretty slow, and especially internal combustion engine cars are really slowing down. The heat pump market is also improving more or less, because he had a pretty strong peak in 2022 before a decline over the past 2 years. There's some signs of improvements in this sector, but the growth at which the new heat pumps are installed is just way too slow to meet the decarbonization targets for in the EU as a whole. So there are signs of improvements, but still some weaknesses that are dampening the overall demand outlook in Europe. Last sector we can look at for demand is data centers, very trendy topic at the moment. It's well, Europe is no exception to the overall AI trend, because data centers will require a lot of electricity to power AI models, to train AI models. But we have to put things in perspective. Europe is lagging behind the US, China in terms of already installed capacity and growth projections. So we can expect the biggest markets in Europe, Germany, France, and the UK, to only grow by 100%, so to double their capacity by 2030, which is already significant, but it's less than what we're going to see in US and China. There is some upside for the overall power demand from this sector, but it's not going to be as dramatic as we can hear in the press or what we can see in the US. Now, with this point of demand, we can move to the other side of the equation. How do we meet this demand with power, which assets generated power in 2025? If we look at the evolution from one year to another, 24 and 25, and we decompose the evolution by source of generation for the whole of the EU, we see two interesting things. Overall generation increased by, well, the implied demand increased, so the overall generation increased by 31 terawatt-hours, so that matches the slight increase we were seeing in demand. Second point is the square, the rectangle in the middle of the slide, is that if you look at low carbon sources of energy, so ranging from biomass to wind, solar, hydro, etc., lots of the movements are offsetting one another. So we had in 2025 a huge normalization for hydro, much less hydro in France and Spain, even underperforming in Italy. So that really weighs on the low carbon generation. While at the same time, we are seeing a huge increase in solar, partly fueled by an increasing capacity for generating power. So that compensates for this loss. Wind underperformed as well, and that had rippling effects on the gas market, as Évariste mentioned already. And lastly, to loop everything, we have the flexible generation. So in part, that can be fossil for most countries. And you can see a decline for coal and lignite. Some plants were retired for coal. But what's really driving the increase is that for gas is that gas assets are just now more competitive than coal assets. So that explains the strong jump for gas. Now we're looking at prices, how this supply and demand balance has unfolded over the past year. If we take a step back and look at what we had before the crisis, we are way higher than what we had. That's for sure. That can be explained by higher fuel costs. So gas is more expensive, carbon is significantly more expensive. So that lifts power prices because they are in a way partly correlated to fuel prices. Year on year, they are roughly stable. There is an increase in Germany and its close neighbors as there was a pretty strong wind deficit. But more or less, we are seeing stable prices. In terms of trend, however, if we take things a step further and try to correct the power prices by the fuel prices, so you divide the power price by the fuel price, you actually see a pretty interesting trend, which is on the right here. You see declining spot prices. Why is that? That's really the effect of renewable penetration or low carbon sources that are competing with fuel assets. So that really have an impact on solar hours during the summer, or wind assets are more often marginal than conventional power plants during all the time in the winter as well. So it's really interesting. That's one thing to keep in mind. This gradual decorrelation that we've been seeing since let's say 2022 is still at play, and in some countries actually stable or even increasing in terms of trends. Now, if we look at the forward, so the forward anticipates what the delivery price is going to be on a certain time window. If we look at the Cal +1, so delivery for the next year, we've seen interesting developments over 25 and early in 26. You see overall German prices were roughly stable, lots of volatility induced by the fuel costs. So fuel costs here are represented in gray and dark gray, with gas taking a clear lead since the summer. And German and its close neighbors are really correlated to this anchor, this price anchor that continues to be a key benchmark for the market. You can see power price as a premium or a discount of this clean gas cost. That's really one way to price power in a way. On the other hand, you can see on the lower part of the chart, the dark blue line, which is the French power price for Cal +1. So dramatic decline throughout the year, especially accelerated since October, let's say, with the market being disappointed with spot power prices in the first part of the winter. It's now stabilizing above 50 euros per megawatt hour. Some tensions on the spot that we are seeing with limited nuclear availability, lower hydro are helping to support the spot. Hence, there's a slight recovery for the French Cal +1 prices. One thing I wanted to touch upon as well is if we try to look further on than Cal +1 actually, is that's gonna heavily influence the supply and demand balance, is the evolution between of renewable capacity. we are seeing solar capacity or solar generators challenge in a way. You can see on the right chart that the capture rates for solar are decreasing rapidly, in part due to the cannibalization effect on this market. While other sources of renewables are holding a bit better, onshore wind as well, in part helped by the wind deficit. But what we can learn from this chart and the blue bars on the left is that we are likely to see a slowdown in installed capacity for solar. We're not going to see a decrease in solar capacity. The capacity is still going to grow as a whole, but there's going to be a rationalization in terms of where the assets are built and how they can be marketed. So that means that all developers are now looking at collocating solar assets with flexibility assets, batteries, to capture revenues on other hours than just solar hours. That's really key for having a viable, financially viable project for solar. Yeah, well, that was the slide. You can have it in the slide deck. But overall, there's this challenge for renewable assets that are seeing lower capture prices. Wind offshore is also under pressure due to rising costs. The tariffs have in the US or are one part of the reason, and without support from the states, it's hard for some auctions to clear. Some auctions were even unsubscribed, in the Netherlands or Germany recently. While with strong support from the state, that like we saw in AR7 in the UK, you can grow in capacity for a lot of projects, so over 8 gigawatts. And so we are likely, I think, to see a shift towards flexibility projects. We are now seeing projects in the gigawatt size that really are going to help shift the over production of some renewables to more tight hours, especially in the morning or in the evening where prices are high. So that's going to be helpful as well to keep lowering prices by using renewable generation throughout the day. Yeah, solar. So I was mentioning solar especially because they are having more visible effects actually on other sources of generation. On the left, mainly there's a huge effect on nuclear generation, where solar is competing with nuclear and displacing nuclear in a way. While the nuclear availability of the fleet is really strong, at records even over the past 2 months, except in January. You can see that on off-peak hours, the generation is comparable to pre-crisis levels, except on solar hours during peak hours, we are seeing a decline. That makes sense from an economic standpoint for EDF, but that can also lead to other issues due to modulation. And we are all expecting soon the modulation report from EDF to know more about this. And last slide to conclude on the short term, there is still this pretty dramatic rally that we're seeing at the front of the curve. It's helped by power fundamentals as well on top of fuel development. Nuclear availability is pretty reduced at the moment. It's going to increase from Monday and from February the 1st, as Flamanville 1 and 3 will be back online. But there's still this uncertainty around hydro for the end of winter with low hydro stocks in France, and potentially for spring as well, as the snowpack is pretty low. So we might see an increase in the spring contracts or Q2 overall. And long-term wise, we still, my opinion is that the market is torn between this demand that's supposed to enter the market, but it's really been slow as the drivers are competing with each other. industrial activity is pretty degraded. But some signals are improving, so we could see an uptake in demand in the next few months. And this demand will be met by actually maybe fewer renewables than what we could have expected 2 years ago, as some of the focus shifts to flexibility assets. And there are also policy developments in Germany that really can, I think, in a way, tighten the market for some of the next 1 or 2 years. Thank you, Julien. I think we might have time for 1 or 2 questions.
Yeah, thank you, Luc. Yeah, we are a bit late on schedule, so we apologize for that. But as you can see, we have a lot of elements to share. So yes, stay with me, Luc, because we have some questions. But I just want to inform our audience that the Energiescan team will be present at eWorld next month at the ENGIE's booth. So eWorld, for those who don't know, it's the biggest energy fair in Europe, organized every year in Germany at Essen. So don't hesitate to stop by the NG booth to discuss with the team or get a demo of our Energiescan platform. One important point as well is the satisfaction survey. So I will launch it and we'll do the Q&A at the same time. So if you can please just take a few seconds to rate this webinar. So yeah, questions for you, Luc. First question on the spot market. Do you see or do you have an explanation? I don't know regarding the price decoupling we can observe between Germany and the Netherlands on the day-ahead market, because we have seen multiple instances where German day-ahead prices were settled significantly above their Dutch counterparts.
Mm.
Do you have a view on this? What this,
Yeah. So the German market, in the way it's currently behaving, has a pretty significant tightness on the supply side. So as soon as you lack wind, so baseload generation, you are calling expensive assets, inefficient assets, or gas peakers that are gonna lift the German power price much more dramatically than what you can expect in the Netherlands, where you still have a strong thermal base for generation. And the price decoupling happens also because there's no infinite transmission capacity between the countries, so there's this effect. Germany is also pulled by higher prices in Austria, Poland, so the east of Europe.
Okay. One question regarding also the frequency of negative prices in the spot market. So we have seen an increase, of course, of these negative prices over the past few years. So what is your view on the possible evolution regarding the number of negative prices in the coming year, at least?
For maybe 2026, I think they're still going to grow, especially if we see more wind or a wind normalization. I think it's going to be a growing trend. As the flexibility and both on via batteries or on the demand side is not sufficient for now, we're still likely to see a greater number of negative hours. However, if we look at how deep those negative hours are, I think we might see a reduction in that sense, that the generators are more price sensitive now, are able to better manage the generation schedule to avoid the negative effects of generating power during negative hours. So we might see prices closer to zero or just slightly below, rather than minus 200. Yeah.
Okay, thank you. So there are some questions unanswered. So don't worry, we'll take some time to answer it in a written way afterwards. So I just would like to thank you all for your attention, and so to also thank those who took the time to answer our survey. So it's now time to close this session. So I hope you enjoyed it, and see you soon on our EnergyScan platform. Goodbye.